Okay, so today we're going to dive into some really interesting ideas about the folks running our economy,
Right.
specifically the PhD economists at the Federal Reserve.
Okay.
We're going to be looking at this through the lens of someone named Kartik.
Right.
And a lot of his ideas have been making waves online, particularly on YouTube.
Yeah.
And a lot of it really kicked off with this Twitter poll he did.
Mm.
And he's been stirring up some serious debate about, whether the experts we trust are actually doing the best job possible.
Yeah, and Kartik himself, he isn't a PhD economist,
Right.
but he's certainly got a lot to say about those who are.
Definitely not holding back.
No, not at all. And at the core of his argument is this question of, does all that fancy academic theory actually translate into good decisions in the real world?
Right, right. Because at the end of the day, it's about what actually works.
Absolutely. And especially when we're talking about something as impactful as monetary policy, which, affects all of us.
Absolutely. So
Yeah.
so let's get into that Twitter poll because it was kind of a starting point for a lot of this discussion.
It was.
So what was the question he posed and what were those kind of eye-opening results?
So he basically asked people a hypothetical question, and he said, who do you think would do a better job running the Federal Reserve's monetary policy?
Okay.
Would it be 100 PhD economists or 100 small business owners?
Interesting.
Just straight up, which group would you trust more with this huge responsibility?
Yeah.
And the results were pretty striking. The small business owners won by a landslide.
Wow.
Yeah, it wasn't even close.
Huh.
And, Kartik sees this as a sign that people kind of intuitively get it. They understand that real-world experience matters when it comes to making economic decisions.
It makes sense. If you think about it, it's like who understands the day-to-day struggles of running a business, dealing with costs, managing employees, all of that.
Exactly, and that's really at the heart of Kartik's critique.
Which brings us to his view on the roughly 600 PhD economists at the Fed right now.
Yeah.
And it's not so much about the number for him.
No.
It's about their fundamental approach.
Exactly. It's not about having more or fewer economists. It's about how they think and what they base their decisions on.
So what's he saying about that?
Well, his argument is that all those 600 PhDs, they might as well be just one PhD.
Whoa, okay.
Because they're all working from pretty much the same theoretical playbook.
Okay.
They're all relying on these macroeconomic textbooks that he believes are seriously outdated, like 50 to 70 years behind the times.
Really? Wow. Okay. So he's saying that the very foundation of their knowledge is flawed in his view.
That's his contention.
Yeah.
Yeah. And he's concerned that those old textbooks don't accurately reflect the complexities of our current economic landscape.
And he doesn't stop at saying they're no better than one house-o. He actually goes a step further and says that having even one PhD economist making these decisions based on this potentially outdated knowledge could be really bad.
Yeah, he really does take a strong stance there, doesn't he?
He does. So why is he so convinced that this is such a detrimental approach?
Well, a big part of it is that he sees this theoretical grounding, this deep dive into economic models as lacking something crucial.
What's that?
Practical experience.
Okay, so he's saying they need more than just book smarts. They need to have actually been in the trenches of the business world.
Exactly. And, to really drive this point home, he uses a pretty powerful analogy.
Oh, yeah, I remember reading about this.
He asks us to imagine a surgeon
Okay.
who's only ever read books about surgery but has never actually performed an operation.
Okay, I get it. So they've got all the head knowledge, but no real-world application.
Exactly. Or picture a dentist who studied all about teeth but has never actually filled a cavity.
Right. It's kind of terrifying to think about.
It is, and that's his point. He's saying that in a similar way, we've got all these PhD economists at the Fed making decisions about the economy without ever having experienced firsthand what it's like to run a business.
Meet payroll, deal with all those unpredictable market forces.
Exactly. All of that's missing. And he's concerned that this creates a disconnect
between theory and reality.
Right. And he calls them, very theoretical people.
Yeah.
Which I think is meant to highlight this gap between their academic knowledge and the practical realities that businesses face every single day.
And he also raises this issue of accountability, right?
He does. He argues that within the Fed, there isn't this strong sense of accountability for policy failures.
Okay.
And that often career advancement comes from sticking to the established ideas, even if those ideas might be flawed or outdated.
Interesting. So it becomes kind of self-reinforcing
In a way, yeah.
Yeah.
And he's concerned that this can stifle dissent and discourage people from challenging the status quo.
So it can create a culture where it's safer to just go along with the prevailing wisdom even if you have doubts.
Exactly, and that can be dangerous.
Yeah, and he also points out something about how these economists interact with each other, right?
Yeah, he observes that there's this tendency for PhD economists to find comfort in agreement,
Okay.
which is understandable. They speak the same language, they have similar training.
Right.
But he worries that this can lead to groupthink, where everyone's on the same page and they're not really considering alternative viewpoints.
And they might miss crucial insights or even potential risks because they're all looking at things from the same perspective.
That's the worry.
Yeah.
And, to be fair, a lot of fields have this challenge.
Of course.
But he believes it's particularly pronounced in economics, especially at the Fed, where the stakes are so high.
And he doesn't just offer this general critique of the Fed's approach, right? He actually gets really specific about recent actions, particularly those rapid interest rate hikes we've seen.
Yeah, that's where his argument really gets into the nitty-gritty of current monetary policy, and he pulls no punches.
So what's his take on those multiple 0.75% increases in the Fed funds rate?
Well, he sees those aggressive hikes as a clear sign that the Fed is misreading the current economic situation. He believes they're overreacting and making decisions based on outdated thinking.
So he's basically saying they're fighting the last war, not the current one.
That's a good way to put it.
Yeah.
Yeah. And in contrast to the Fed's tightening, he actually advocates for a 0% Fed funds rate.
Wow. Okay, a complete opposite approach.
Yeah, and he goes even further. He wants to see continuous quantitative easing.
Okay, so remind us what quantitative easing is again.
Sure, it's basically when the Fed pumps money into the economy by buying assets like bonds, it's a way to try to stimulate growth and lower interest rates.
Right.
And Kartik believes that this, along with a 0% Fed funds rate, is what's needed right now.
And this is tied to this idea of technological deflation that he talks about, right?
Yes, that's a key part of his reasoning.
Can you break down that concept for us?
Sure. So technological deflation is this idea that advancements in technology are inherently driving down the cost of goods and services.
Okay, so things are actually getting cheaper because of all the tech innovation.
Exactly. And he argues that this creates a natural downward pressure on prices, a deflationary pressure.
Which is the opposite of inflation.
Right.
So he's saying the Fed is focused on fighting inflation when they should be more concerned about deflation.
That's his view. Yeah. And he believes that the Fed's models, their outdated models, don't properly account for this powerful force of technological deflation.
Interesting. And he also looks back at the Fed's past actions to make his case, right? He brings up the 2008 financial crisis as an example.
He does. He points to the fact that there was this significant lag between the housing market crash and when the Fed finally lowered interest rates.
Okay.
And he sees this as a pattern of being slow to react to what's actually happening in the economy.
So they were behind the curve.
Exactly. And he blames this on their reliance on those theoretical models that he says just don't capture the nuances of the real world.
And he even mentions a more recent instance in 2016 when the Fed tried to raise rates despite low inflation.
Yeah, that's another example he uses to illustrate his point.
And what was his interpretation of that?
Well, he believes that the Fed was spooked by the low unemployment rate at the time.
So they were worried that too many people having jobs would eventually lead to inflation.
Exactly. They saw it as a sign that the economy was overheating even though inflation was still pretty tame.
And he sees this as another case of being too focused on theory and not enough on the actual data.
Exactly. And then fast forward to the current situation with these rapid rate hikes, his take is pretty blunt.
Yeah, he doesn't mince words.
No, he sees it as a sign of panic, almost like they're flailing around trying to regain control.
Like they don't really know what they're doing.
Yeah, he compares it to a novice day trader who's overcompensating way too late in the game, making these huge moves out of fear and uncertainty.
That's a pretty harsh assessment.
It is, but he truly believes that these big swings in the Fed funds rate are incredibly damaging to the economy.
And he even goes so far as to say that no economy can function properly with this kind of volatility in interest rates.
Right, it creates so much instability and unpredictability, and that makes it really hard for businesses to plan for the future.
And can undermine consumer confidence, too.
Absolutely, because when people are uncertain about the future, they're less likely to spend money and invest, and that can have a ripple effect throughout the entire economy.
This is where this thing called the WUJA shadow federal funds rate comes into play.
Right.
So what is that, and why does Kartik make such a big deal about it?
It's basically a way to try to get a more accurate read on the true stance of monetary policy, especially when The traditional Fed funds rate is close to zero, like it was for a while.
Okay.
And the Fed is using all these unconventional tools like quantitative easing.
Right.
So it tries to estimate what the equivalent interest rate effect would be, taking all those things into account.
So it's kind of like a shadow rate that reflects the actual impact of all these different policy moves?
Exactly. And it can even go negative,
Yeah.
meaning that it's suggesting monetary policy is so loose that it's like the equivalent of having negative interest rates.
Okay, and what does Kartik see when he looks at the trend of this Wuja shadow rate?
He sees a downward trend, which aligns with his argument about technological deflation.
So it's suggesting that monetary policy should be getting even looser.
Right. And he suggests that by late 2022, this shadow rate should have been significantly negative, maybe around -3% or -4%.
Okay, but the actual Fed funds rate was quite different, right?
Very different. It was actually close to +4%.
So there's this huge gap.
An enormous gap. Yeah, almost 8 percentage points.
Wow.
And Kartik sees this as a massive policy error, a sign that the Fed is way off track.
And this isn't just some theoretical disagreement for him, right? He sees this as having real-world consequences.
Absolutely.
Yeah.
He believes this misalignment has the potential to cause serious economic harm.
Okay, so let's move on to his thoughts on the Fed's response to inflation, because he's got some pretty strong opinions there, too.
He believes that the Fed is completely overreacting to inflation data that's already showing signs of cooling down. Yeah, he points to the Bureau of Labor Statistics CPI data, which is one of the main ways we track inflation.
Right.
And he notes that the short-term measures of inflation, like the 2-month, 3-month, and 6-month percentage changes, have already peaked.
Oh, okay.
And they're trending downwards.
So she's saying the inflation wave has already crested.
That's what the data suggests.
Yes.
Yeah. And he anticipates that the longer one-year measure will follow suit.
So the Fed is essentially fighting yesterday's battle.
In his view, yes, they're reacting to those peak inflation numbers around 8%.
Right.
But not recognizing that the rate of price increases has already started to slow down.
And he also brings up the Fed's stated intention to reduce the number of jobs to combat inflation.
Yeah, that's another point of contention for him.
So what's his take on that?
He's very critical of this approach. He finds it deeply concerning that the Fed is actively trying to cool the labor market, meaning that they're basically trying to engineer job losses. Yeah, potentially millions of job losses, all in the name of fighting inflation that he believes is already on the decline.
So he sees this as a very misguided and potentially harmful strategy.
He doesn't see the justification for it, given the data he's looking at.
And to get an even broader sense of the inflation picture, he also looks at the Goldman Sachs Commodity Index, or GSCI.
Right.
So what is that, and what does it tell him?
The GSCI is basically a global index that tracks the performance of a wide range of commodities.
Okay.
So it's kind of like a big picture view of inflationary pressures across the world.
And it's harder to manipulate than something like the CPI.
That's his view, yeah.
So what does the GSCI show?
Well, it shows that this index peaked about 6 months before his commentary and has been falling ever since.
Okay.
And he also points out that it has a relatively low 10-year growth rate.
So not exactly screaming inflation.
Right, and this leads him to question the entire rationale for the Fed's aggressive tightening.
Okay, so let's bring it all home and talk about the impact on mortgage rates in the housing market, because things have been pretty crazy there.
They have, and Kartik is very concerned about this.
So what are his main points here?
Well, first he highlights how much 30-year fixed mortgage rates have gone up. They've basically tripled from those pandemic lows to nearly 7%.
In a very short period of time.
Yes, very rapidly. And he explains how those rock-bottom rates after 2020 might have lured a lot of people into buying homes at inflated prices.
Right, because when rates are low, you can afford to borrow more.
Exactly. And now, with rates so much higher, those folks are in a very precarious position.
Because they're stuck with these much higher monthly payments.
Right, and if home values start to fall,
they could end up owing more on their mortgage than their houses were.
Exactly, which is called negative equity. And that's a really scary situation to be in.
It is, and he actually draws comparison to the lead up to the 2008 housing crisis.
He notes how quickly and dramatically mortgage rates have risen this time around.
So he's saying it's even more abrupt than what we saw before that last housing bust.
Yeah, he sees some real parallels there, and he reminds us that there's usually a lag between when the Fed raises rates and when those hikes actually ripple through the economy.
Right. It takes time for those effects to fully materialize.
Exactly. 6 to 9 months, sometimes even longer.
So he's basically saying the Fed is raising rates so quickly that they're not even waiting to see the full impact of the previous hikes.
Exactly. He calls this overshooting.
And his outlook for the housing market and the broader economy isn't very rosy, is it?
No, he's quite pessimistic. He predicts a major downturn in housing and a very high likelihood of a recession.
As a direct result of these Fed policies.
In his view, yes.
And he keeps coming back to this core argument that the Fed's actions are rooted in a specific way of thinking.
He believes their approach is too theoretical, too disconnected from the real world.
So just to wrap things up, what's Kartik's central message here?
His central message is that this reliance on PhD economists with what he sees as outdated theoretical knowledge is a major problem.
And it's leading to some really harmful economic consequences.
That's his view, and he's very vocal about it.
So he's really challenging this whole notion that we should just blindly trust the experts.
He's asking us to question their assumptions and look closely at the data, and he's raising some really important points about the potential dangers of groupthink and a lack of accountability.
And his big concerns right now are these rapid interest rate hikes, the disconnect from what he sees as easing inflation, and the high risk of a severe housing downturn and a recession.
Those are his big worries, yeah.
And he leaves us with a very provocative thought.
Yeah, he does.
He says that all these economic challenges we're facing aren't just some inevitable outcome.
Right.
He believes they're entirely artificially created by what he calls the incompetence of PhD economists and the outdated nature of macroeconomic thought.
Wow, so he's laying the blame squarely at the feet of the Fed.
He is, and it's a pretty bold statement.
It is, and it certainly gives us a lot to think about.
It does. It makes you wonder if there's a different way, a better way to approach monetary policy.
Well, that's the question, isn't it? And I think Kartik would say the answer is a resounding yes.
All right, well, that's all the time we have for today's deep dive.
It was a good one.
But it certainly gives you a lot to ponder. So until next time, happy investing, everyone.
Take care.
Bye.